All right, well, we're a couple minutes after 1 o'clock. Some people are still starting to come in a little bit, so I think we'll give it one more minute. I do want to respect your time though, and so we're not going to wait too much longer before we dig in on Social Security planning for couples. Um, I'll say that this is specifically, this one particular presentation is designed for um, claiming strategies for couples. And so we're looking at two people here, spouses really, because that's where the rules apply, and how it makes sense to kind of, what kind of approach you might want to take with Social Security. So we'll wait just about another minute here. The market's closed today, just closed a couple of minutes ago, down a little bit today. All right. Well, we're 3 after. We just had another one sign on. I think we'll have some more here as we continue to go. But I want to welcome you. I appreciate you coming and joining us for the Savvy Social Security Planning for Couples presentation. As you might expect, if you've talked to any of the advisors here, Savvy Social Security Planning for Couples and Savvy Social Security Planning just kind of generally is an important element of what we do when we do retirement planning. Even though Social Security benefits are paid to individuals, the rules for spousal benefits and survivor benefits means that husbands and wives need to coordinate their benefits and make their claiming decisions as a couple. When I say claiming decisions, I'm talking about claiming your Social Security benefits. So I think you'll see what we're talking about here as we go along. As I mentioned a little bit earlier, there's a Q&A function in here. There's also a chat function as well. And so if you have something to post in the chat, please feel free. In the Q&A as well, please feel free. If you're having trouble hearing me or if there's some sort of technical issue on your end, you can let me know and I can try and fix it as we go along. I'm certainly happy to answer your questions as we proceed, and then we can answer some more as we wrap up if you have them at the end. I'll check these questions as often as I can without kind of getting in the way of the presentation. So with that in mind, let's get started. I'm going to actually turn off my camera here so we can focus really on what's going on here on the slides. And where I want to really start is that I first want to point out how valuable Social Security is. Social Security is one of the few sources of income that you can't outlive. If you're worried about running out of personal assets as you get older, whether it's your 401k or your IRA or something similar, you don't need to have that fear with Social Security because it continues until you die. And of course, the longer you live, the more you will extract from the system. Someone's life expectancy is always the great unknown as we try and calculate things with Social Security. So we've got an example here of how benefits work. And we're going to start kind of in this presentation, we're going to begin with the basics and work our way up to the strategies. So if your benefit starts out at $2,000 per month, and if you live 10 more years, you'll receive nearly $300,000 in lifetime benefits. If you live 20 more years, you'll receive over $600,000 in lifetime benefits. And if you live 30 more years, you'll receive over $1 million in lifetime benefits over your life. Now, this assumes annual cost of living adjustments or COLAs of about 2%, which is reasonable, I think. And cost of living adjustments do come into play with Social Security benefits. We'll talk about that a little bit more in the future. So there's quite a bit at stake here as we talk about lifetime benefits. Second, Social Security offers annual inflation adjustments, as I was mentioning. So if your benefit starts out at $2,000 a month, and if cost of living adjustments or COLAs are 2%, in 10 years, you'll actually be receiving $2,438 a month. And in 20 years, your benefit will be $2,972. And in 30 years, your check will be $3,623 if you're still receiving benefits by check and not direct deposit. Now, there's no way of knowing exactly what future cost of living adjustments will be. As I mentioned, 2% is a reasonable estimate. It hasn't been there lately. Cost of living adjustments are really tied to inflation. So if we have low inflation, you're not going to see as much of a COLA adjustment, but they do come into play here. So There are a couple of terms that we're going to need to understand as we get rolling here. One of the most important of those terms is full retirement age. Full retirement age is a Social Security term that describes the age at which you can start receiving full, unreduced Social Security benefits. Full retirement age used to be 65 for everyone, and 65 is still an important age for Medicare. But for Social Security, in 1983, Congress actually raised the full retirement age, which is gradually phased in. So if you were born between 1943 and 1954, your full retirement age is 66. And if you're born in 1960 or later, your full retirement age is age 67. And so that comes into play in a few different ways. The next important concept, though, to understand is your primary insurance amount. So full retirement age, at full retirement age, you receive your primary insurance amount. Social Security benefits are based on your work history. And even though the formula is a bit complicated, the important thing here to know is that it's based on your highest 35 years of earnings. So the more you earned each year up to the annual Social Security maximum, the higher your benefit is going to be. And Social Security continues to update your earnings record. So even if you work into your 60s and 70s, and even after you've started receiving your Social Security benefits, it can keep growing for every year that you work. Keep in mind, it's the top 35 years. And so if in year 36, you're earning more, as you keep earning more, you're going to drop off the 36th lowest year, if that makes sense. So your paper route or from waiting tables or whatever it was that you had as a kid that you're contributing to Social Security, that will fall off. So if you're wondering about how you might be able to increase your Social Security benefit, there's one way here, is to keep working. And to find your primary insurance amount, the easiest way is to just look at your annual Social Security statement. If you're not receiving it in the mail, you can find it on the Social Security website. And that primary insurance amount is your benefit at your full retirement age. You'll see the arrow pointing at it in this example here. And so in this example, the benefit amount at full retirement age is $2,029 a month. That is the primary insurance amount. So now you can file for Social Security as early as age 62, but there's several reasons not to file before your full retirement age. And the biggest reason is that your benefit will be permanently reduced. I have a question here. It says, if you retire early, does Social Security count only the 30 years employed to determine the final amount? Yeah, it's going to be your top 35 years. So if there are years where you didn't work, those zeros will be counted in there. A good example is if someone, historically we've seen actually women step out of the workforce if they're having and raising children. Now that's not so much the case as much today, but we've seen that, of course. And so there can be gaps in employment there that does lower your overall Social Security benefits because you haven't paid in. I hope that answers your question. As I mentioned, you can feel free to ask questions through this. If I for some reason I don't get to your question or answer it fully and you have follow-up questions, you can always reach out to me and email me. You can call us at the office. You can talk to one of, I presume that you may have an advisor here at Ford Financial Group. You can talk with your advisor and they can answer your questions for you as well. So getting back to full retirement age, the biggest reason why you don't want to file before your full retirement age is that your benefit is going to be permanently reduced. And then also there's the earnings test. If you work, $1 in benefits will be withheld for every $2 that you earn over the threshold, which in 2020 is a little bit more than $18,000. So there are certain spousal strategies that are being phased out, but are still available to people born in 1953 or earlier. But if you file before full retirement age, you really can't take advantage of them. So that's another reason why waiting till full retirement age, for starters, is going to be one of your best bets for Social Security success. And then finally, if you're the high earning spouse of the family, filing for early reduced benefits will actually lower your spouse's survivor benefit if you die first. This is actually one of the most important reasons not to file for Social Security before full retirement age. I'll talk about this a little bit more later as we get into the strategy part of things. So the question then is, when should you apply? And it's important to remember a few key points. If you apply early, your benefit starts lower and stays lower for life. As I mentioned, cost of living adjustments or COLAs magnify the impact of delayed or early claiming. So the higher your benefit, the higher your annual inflation adjustment will be. And that makes sense, right? If we're applying, let's say 2% in the example from earlier, 2% on a larger number is going to give you a larger number of a cost of living adjustment. And then the when to apply question impacts survivor benefits as well. The higher earning spouse usually should delay the start of benefits to increase income for the surviving spouse. The higher benefit will be between couples. The higher benefit will be preserved regardless of which spouse dies first. So delaying benefits is like getting a little bit of extra life insurance, for example, that you don't have to pay for. So with that background kind of understood here, let's talk a little bit about spousal benefits. Oh, I see another. Oh, no, that was the question we answered before. Okay. So let's dig into spousal benefits. These aren't just for non-working wives any longer. That was the genesis of spousal benefits, really, was spouses that were out of the workforce weren't left out in the cold by Social Security. But that's not things have changed, right? It's 2020. Lots of things have changed now. And it's even important to know that, by the way, that the Supreme Court has ruled that same-sex marriage is legal in all states. This actually means that same-sex couples who are legally married are eligible for spousal and survivor benefits the same as any other married couple. So that's noteworthy here. So let's dig in. I think an easy way is to work through an example, but according to the rules, the spouse of a worker entitled to Social Security may claim a spousal benefit. Entitled means the worker spouse is eligible for Social Security and is filed for benefits. So we're going to work on an example here. This example is Jack and Jill. Jack and Jill are married. They're both 66. Jack has paid into Social Security all his life, and his primary insurance amount is $2,400. Jill has never worked. Once Jack files for Social Security benefits, Jill can file for her spousal benefit. Jill's spousal benefit will be 50% of Jack's primary insurance amount, or $1,200, right? That makes sense. It's easy to understand. Your spousal benefit is half of your spouse's, right? Or what's available to you as a spousal benefit. What's worth mentioning here before I even get the question, in this case, Jill's spousal benefit has no effect on Jack's. Jack would collect $2,400 for his primary insurance amount. Jill would collect $1,200 for her spousal benefit, and together they would have their benefits of $3,600 a month, and one does not affect the other in this case. So with that kind of premise in mind, let's work on some savvy spousal strategies. Try and say that 3 times fast. As a married couple, the amount of income you'll receive and the total amount of benefits you stand to receive over your lifetime depends on when you each originally claim your Social Security. So there are several ways you can go depending on your goal. Do you want maximum lifetime benefits over your projected life expectancy? If so, you'll be taking less income now so you can have more income later. Makes sense. Conversely, do you want to claim Social Security at your earliest opportunity? It'll give you more income now, but less income later. I will say that we generally don't recommend this early claiming strategy because when you start out with a lower benefit, it doesn't do a very good job of keeping up with inflation. And then some couples prefer the hybrid strategy, which gives them some income now and more income later. So let's look at some examples here. In this example, we've got Jane and Joe. Both are 58 years old. Jane was the higher earner of the two and has a primary insurance, or PIA, of $2,400. We're going to assign her a life expectancy of 85, which is about average. Now, Joe has also worked and paid into Social Security, and he has a primary insurance amount of $800. We're going to assign him a life expectancy of 95 because he could live that long, and we want to see how the Social Security plays out if he does. So these are the inputs that we're going to use as we calculate this. one of the ways we do it here at Forward Financial Group is we have a spousal planning calculator that we can use and put together. We'll talk about that a little bit more later, but it helps us come up with some claiming scenarios here. So for these two, let's look at their strategy for their earliest benefits. If Jane files at 62, her starting benefit would be $1,680, which is 70% of her primary insurance amount. This would be her permanent benefit. It wouldn't go up when she turns full retirement age. And if Joe files now, he'll be filing for both his own and his spousal benefit. So his starting benefit would be $820, or about 34% of Jane's primary insurance amount. This is actually a combination benefit. This is where it gets a bit confusing. And you can, of course, email me if you have some questions. But the combination benefit essentially consists of his own reduced benefit of $560 plus a reduced spousal add-on of $260 for a total benefit of $820. So this is also a permanent benefit until Jane dies, and then Joe would step up into Jane's higher benefit. Remember, we had Jane living to 85 and Joe living to 95 in this example. Now let's look at what they'd get if they each claim at age 70. This is when benefits stop growing. Jane's benefit would earn 3 years of 8% annual delayed credits to give her a benefit of $2,976. And Joe's benefit maxes out at 50% of Jane's primary insurance amount, or $1,200. And these numbers don't include cost of living adjustments that we mentioned earlier. So by the time they actually get to age 70, the amounts might be a bit higher than this. In fact, I think it would be likely that they're a bit higher than this. So under the hybrid, so we did the early withdrawal and we looked at what would be the maximum possible benefit. But let's talk about scenario number 3. And under the hybrid strategy, they get some income now and more income later. And under this strategy, the higher earning spouse maximizes the benefit by claiming at age 70. The lower earning spouse gets some income started by claiming at age 62. So in this case, Joe would claim on his own reduced benefit at age 62 and receive a starting benefit of $560 a month. When Jane turns 70, she starts her maximum benefit of $2,976. Now remember, for every year she delays past her full retirement age of 66, her benefit increases by 8% a year. And that does not include cost of living adjustments. So by the time Jane gets to age 70, her benefit is likely to be even higher than this, what we're looking at here. Once Jane files for her benefit, Joe then becomes entitled to a spousal benefit. His spousal add-on is the difference between his primary insurance amount and 1/2 of Jane's primary insurance amount, or $400. So that $400 will be added to his existing $560 benefit to give him a total benefit of $960. Now, this isn't quite 50% of Jane's PIA, or primary insurance amount. The reason is that Joe took that reduction for early claiming. Recall, he started claiming at 62. So the spousal add-on is added to $560, not to $800. And so that's why he gets the total benefit of $960 instead of $1,200. We call this a hybrid strategy because it doesn't quite maximize Joe's benefit, but it does get income started a little bit sooner. So you can see here on this chart as we compare the strategies, excuse me, that this chart pretty clearly shows the claiming strategy that will give them, that this hybrid strategy gives them the most lifetime benefits, assuming Jane lives to age 85 and Jack lives to 95, and the cost of living adjustments are what the roughly 30-year average has been, which is about 2.6%. So given those assumptions, the best strategy for this couple would be for him to claim at 62 and for her to claim at 70. Now, I'll tell you, this isn't going to be the case for all couples, right? Life expectancy plays a big role in this. And of course, we can't really predict the future in that sense. So we take a stab at making some estimates based on people's health. And so oftentimes we'll see that if both spouses claim later, they will have a maximum lifetime benefit, but sometimes the hybrid strategy isn't much less than that. So that's helpful. I have a question from Suzanne. Joe has to wait until Jill is age 70 to add his spousal benefit, and then he takes his benefit and her benefit. I will say sort of. Joe, the key here is to To claim your share of your spouse's benefit, the spousal benefit, the benefiting, how do I phrase this? The benefiting spouse has to claim. So let me use myself as an example. If my wife is going to claim her spousal benefit on my Social Security, I need to file for my Social Security benefits. She can't file for her spousal share without me filing my claim for my benefits first. So that's part of the answer. He does take his benefit and her benefit. Basically, he is getting his spousal share. Technically, what Social Security does is simply add on to your own benefit to get you to your spousal share. And that's why there's a differentiation between Joe claiming his own and then this addition of his share of Jill's. I hope that answers your question, Suzanne. I'm happy to dig into some more detail about that if you'd like to do it separately. It does get a bit confusing, but it's important here to recognize that there isn't just one way to go about this. It kills me when I hear people say, I'm just going to claim Social Security because I don't know if it's going to be there for me. It's going to be there for you. It may not be there for your kids or grandkids in the same way. In fact, there are some things that, well, I'm not going to get too deeply into it. The way Social Security is taxed, the extension of your full retirement age, like we've already done in the past, those are some things that can extend the life of Social Security. But don't let the worry about it not being there for you be the reason why you're claiming early. Because you can see here very clearly the difference of them claiming early and them not claiming early. And it's hundreds of thousands of dollars over their lifetimes. So this is actually the chart that I really want you to pay attention to, especially for women if you have learned less over your lifetime than your husband. And if your husband dies first, which is statistically likely, I'm not trying to be morbid or pick on the guys here, but it's statistically likely, your first year survivor benefit will be lower if your husband claims his benefit at 62. So in our example, our husband outlived the wife. And so Joe's survivor income would be a little bit more than $41,000 a year if Jane had claimed her benefit at age 62. But it would be over $70,000 a year if she claimed at age 70. So when you make your Social Security claiming decisions, it's important to think about the age at when you claim your benefit and how that might affect your survivor's benefit. That's a really important element here. So the three scenarios that we looked at here were maximum with benefits, earliest benefits, and hybrid benefits. They're not the only ones that are available to you. So if you have other ideas about when you might want to claim benefits, we can run those scenarios also and see how they compare. And when we run these scenarios, we can provide you with a customized report showing you how several possible claiming scenarios compare to one another. I have a question here from Cheryl. Sorry, I missed something to look up my Social Security benefits. I have a few questions. I'll ask one at a time. She is 60 and retired. Her husband is 67 and employed, most likely retiring at age 70. They have other income. What's the best strategy to maximize their Social Security? If they both file at 70 and do not receive individually their full amount as indicated by SSI. So Cheryl, I would encourage you to reach out to your advisor here at Ford Financial Group, and we can run a specialized report for you. Generally, you don't have to worry about once you're past, once your husband is past that his full retirement age, the treatment of benefits and tax changes a little bit to your benefit. And if he's still working and you don't need the money, it might, depending on his health, might make sense for him to wait till age 70. And so the hybrid strategy that we're talking about for you might make sense. If you were to claim at 62 and he was to claim at 70 and then you kick in the spousal, that might make sense. I can't answer that specifically though, because we would really need to take a look at your Social Security statements. And that's really what we're talking about here a bit as we talk about running these reports, using the Social Security statements that you and your spouse get from the Social Security website, or if you're still being mailed those, that gives us the information that we need, your primary insurance amount and your full retirement age. Those are the key items that we can then use to run the report, compare different claiming strategies, and find out which makes the most sense for you. So before we wrap up here, and I can take some more questions at the end, I want to do a quick review of just Social Security couples planning. First, make your Social Security claiming decisions as a couple. Although benefits are each paid to you individually, the decisions that one spouse makes can directly affect the income of the other spouse. And we saw that specifically with survivor benefits. Second, take advantage of spousal benefits as the rules allow. It's important to use those spousal benefits to your advantage. And plan for the surviving spouse. Think about what's going to happen after one of you dies. That spouse's Social Security check is going to stop. And I always say, you know, the bill from Comcast or the Fresno Bee doesn't change if one person's watching TV or reading the paper. So it's important we want to maximize that. So assuming the surviving spouse won't want to drastically change his or her lifestyle, he or she will need to find income from other sources to meet expenses. And figure out now where that income is going to come from. And then finally, integrate Social Security into the rest of your retirement income plan. If you haven't had a retirement income plan run here by us, I would say get a hold of your advisor and check that off the list. Social Security isn't enough for most people to live on, and you're going to need income from other sources, whether you have a pension, retirement accounts, investment accounts, or whatever. We can help you design a comprehensive retirement plan that integrates Social Security with the rest of your resources with the goal of providing you income that you need throughout your lifetime. Social Security, though, is a big part of that. And obviously, if you can maximize your Social Security benefits, it will serve you well as you go on into the future and as we plan for your retirement and the various ways that you take your retirement. So with that, I want to thank you for attending our Social Security seminar. We've gone for about a half hour, and so I can take questions. If you have some questions, now would be a good time. I don't see anything in the chat. I think we've answered the few questions that we've had. I'll encourage you to email us. If you have an advisor here, I would say get a hold of your advisor directly so we can make an appointment and prepare a customized analysis for you. If not, you can email us at info@forwardfg, and we can talk about how we can connect and kind of start the planning process for you. Our office phone number is also here. It's 559-449-8690. You can reach any of us that way. Raphael is asking, can you please share the slides? I can send the slides to you, Raphael. We are actually recording this session, and we will have it posted on our YouTube page. And so you can go back and take a look at the presentation and pause and rewind and see what kinds of things may have been missed. I see another question here from Cheryl, still confused. So if I wait to 70, do I get my full retirement account amount if I've achieved 40 credits? Also the same for my husband. Yes. I think it's important to kind of slice this a little bit thinner. Your primary insurance amount or your full retirement benefits come at your full retirement age. So that's either going to be 65 to 66 to 67. That can grow by 8% a year up until age 70. So the maximum you will collect if you have paid into enough, like you said, for 40 credits, if you paid into enough for Social Security, your maximum will be at age 70. Your husband's maximum will be age 70. Everybody's maximum is at age 70. Where this hybrid strategy comes in that we discussed is if you wanted to begin taking benefits a little bit earlier. So the follow-up question here, so if you both wait till age 70, is that the best case scenario if you can do it? Generally, the answer is yes. That's what I've seen in most cases. Waiting till age 70 will maximize your benefits, but it's not always the case. And in the example that we gave today, we saw that in that scenario, that couple was able to actually draw benefits a little bit early and not sacrifice. In fact, in the scenario, they didn't sacrifice anything. In fact, over their lifetimes, they were able to collect more in Social Security benefits. Some of that came because the husband, who was the lower earner, started drawing earlier and then had 10 years of the spouse's higher benefit going to age 95. And so one of the factors in here, of course, is life expectancy. And so that can kind of change some of this. And so that's why I would suggest, if you have your Social Security statements, let's do an analysis for you. Shoot them over to your advisor here at the office, and we can run it through, prepare the report, and look at all the different scenarios. So we're not just guessing at which one might be the best for you or which one might produce the most benefits for you over your life expectancy. And that way we can kind of see it in black and white and plan accordingly. So those are all the questions that I see here. As I mentioned, I would encourage you to email your financial advisor. You can email me. My email address is here on the screen. And you can call me or call our office or your advisor at 449-8690. Thanks again for watching, and I look forward to seeing you in January when we do our next one of these. We'll have one specifically on Social Security planning for women. So we're going to take off the December month because everybody's going to be focused on Christmas, presumably, and we'll get back to things in January. So thanks, and have a wonderful Thanksgiving. Merry Christmas, Happy New Year, and we'll have another one of these next year. Take care.